Greetings of the day. In this video lecture for BCom 4th semester Financial Accounting, we will start with the next method for valuation of goodwill, that is weighted average profit method. In the earlier videos we have seen the simple average adjusted profit method. In this we will see weighted method. The question has been provided into the link of the question has been provided into the description box of the video. From there you can, by clicking on that link, you can refer to the question. Solution would be discussed by us in this video lecture. So the question says that for a company we have been provided with certain details which includes its profit for 4 years, which has already been given weight in the question. At the same time we are also been provided with their profit and certain adjustment related with the respective years for the particular firm. So the profit for first year is 30,300, for second year is 31,200, for third year is 36,000, and for the last year, that is 1999 and 2000, it is 45,000. For the year 96-97, weight is 1. For the year 97-98, weight is 2. For the year 98-99, weight is 3. And for the last year, that is 99-2000, weight is 4. Adjustment include that there was certain major expenditure related with the repairs which would be which was charged to revenue, but it should be taken as capital expenditure for goodwill calculation. Similarly, with respect to depreciation, there was another adjustment, and third adjustment was related with the overvaluation of the closing stock in the year 97-98, and lastly, the fourth adjustment is related with the annual charge of cost of management for all the respective 4 years. We have been asked to value the goodwill on the basis of 3 years purchases by using weighted average profit method. For the purpose of calculation of goodwill by using this method, we have to first of all go for calculation of adjusted profit. Calculation of adjusted profit. In this, one column would be for particulars and the other column of amount would depend on the number of years which are being given into the question. For this particular question, 4 years are being mentioned: 96-97, 97-98, 98-99 and 99-2000. Hence 4 amount column are being taken here. So we have to draw a simple format for this question. 5 column format would be required. First of all, we will write the thing that would be our profit, which is given in the question as it is. So net profit is given for 96-97, 30,300, for 97-98, 31,200, for 98-99, 36,000, and 99-2000, it is 45,000. First adjustment is related with the major repair work which was charged to revenue by the company, but for the purpose of calculation of goodwill, it would be treated as a capital expenditure. As it was charged to revenue, what we have to do? We have to add it again. Charge to revenue means it was deducted from our revenue in the year 97-98 when that expenditure occurred. As it was deducted there, we would add it up again here, 9,000, and this adjustment was only in the year 97-98. Hence in this year, 31,200 plus 9,000 is equals to 40,200. As the expenditure was charged only in the year 97-98, hence the rest of the years are marked as nil and their total has been brought down for each year as per the adjustment. Then next thing which was given again into the first adjustment related to this major repair was related with the depreciation of that particular repair work. That particular repair work would be treated as a capital expenditure. Hence it should be subject to charge of depreciation for calculation or for valuation of goodwill. Remember one thing, as it was charged as a revenue expenditure, hence it was not applicable for the goodwill. But here, as we have charged it under the head of what? Capital expenditure, as it was considered capital expenditure, and capital expenditures are subject to the depreciation. The rate of depreciation was given as 10% diminishing value. 10% diminishing value into the question. what we have written, depreciation on major repair work considered as an capital expenditure but not provided before in revenue, as it was charged into the revenue work as in the revenue account as an expenditure, revenue expenditure, hence it was not charged to depreciation, but here we have taken it as a capital expenditure, hence 9,000 is subject to 10% depreciation. From which year? From the year 97-98. Here 900, 9,000 into 10%, 900. Once we get, I would just write it down for here, 9,000 into 10% is equals to 900. Then for 98-99 it would be 8,100 into 10% equals to 810. That is what we have taken here. Then again for 99, 2000, 8,100 minus 810 would equals to 7290 into 10% equals to 729. All these are working notes which you can note it down for the purpose of calculation of depreciation. As the method given into the question was diminishing value method, hence it is subject to reduction in the depreciation in each year. First year when the expenditure, capital expenditure was done was 97-98, depreciation would be 900. Second year it would be 810, and for the third year it would be 729. And respective profit would be for 96-97 30,300, no adjustment past year. For the year 97-98 it is 39,300. For 98-99 35,120, 190, and 99-2000 it would be 44,271. This is the first adjustment which was given into the question. Now moving to the second adjustment that was given is there was an overvaluation of the closing stock in the year 97-98. It means that we have overvalued our stock by rupees 3,600, 3,600. Hence, what we have to do? We have to deduct that 3,600 from the closing stock of the year 97-98, as it was overvalued. Hence, we have deducted here 39,300 minus 3,600, so that we can get our actual profit. Second thing, what we have also discussed in the earlier thing, that is 31st March opening stock is equals to 31st March closing stock is equals to 1st April opening stock. That is what is the standard rule which we are seeing or which we are using since our 11th, that previous year closing stock is current year opening stock. So if the goods were overvalued in 31st of March as closing stock by rupees 3,600, it means that opening stock was also overvalued by 3,600. Definitely. So if we have to do that thing, so we can say that हमको क्या करना चाहिए था, opening stock में से minus करना चाहिए था, so that we can get our real value. But what happened? When we get this amount, these are already adjusted amount. Opening stock is already been deducted, hence minus would be plus. Hence, whenever there is an overvaluation of the stock and in the previous year closing stock is deducted, hence next year opening stock would be added. As the both go in reverse pattern. Hence we have added 3,600 here. Therefore, for the year 96-97 and 99-2000, there would not be any kind of adjustment, and profit would be carried as it is, 30,300 for 96-97. For 97-98, we have to deduct the overvalued amount from our profit. That would be net amount would be 35,700. For 98-99, opening stock was overvalued, hence it was added, and our value is 38,790. For the last year there was no adjustment, hence 44,271 is the constant amount till now. Now moving to the third adjustment which was given into the question, it said that there is an annual charge of cost of management for the all years by rupees 7,200, which is to be charged for valuation of the goods. Hence, that 7,200 is standardly deducted from each of the year. We have deducted 7,200 in each year. That is why 30,300 minus 7,200, 23,100. Similarly, For 97-98, 28,500. For 98-99, 31,590. And for last year, it is 37,071. This is the most important segment where we can find out our adjusted profit. This adjusted profit, once we get, we can easily prepare this second question of valuation of goodwill. So what we have to do? We have to first of all write the profit. Then if there is a capital expenditure created for valuation of goodwill, then that expenditure should be added. Its depreciation should be deducted. If there is an overvaluation of closing stock, that particular closing stock is to be deducted and opening stock is to be added. If any other specific expenditure is given, it should be added or deducted, or whatever the adjustment is given, according to that we have to pass it on and we would get our adjusted profit. Once we get our adjusted profit, half the work is done, only half portion is remained, which is very simple. After completion of the calculation of adjusted profit, we have to go for calculation of weighted average profit. Calculation of weighted average profit. First column would be for year, second column would be for adjusted profit, third would be for weight, and fourth would be for product. We will discuss it. First of all, I have written all the years from 96 to 2000. Then adjusted profit, which we have just calculated. Once all 4 years has been written, weights are already been given into the question. If suppose the weights were not given into the question, still we will write it as first year as 1, 2, 3, 4. Weight means it is the weightage which is given to the respective year. So how we are going to calculate profit? It would be adjusted profit multiplied by weight is equals to product. If I would name each column as A, B, C and D, so how we can calculate D? B multiplied by C. This is how we can calculate our product, that is profit multiplied by weights. So first year profit is 23,100 multiplied by 1, 23,100. Second year profit 28,500 into 2, that is 57,000. Third year profit 31,590 into 3, 94,770. Fourth year profit 37,071 into 4 is equals to 1,48,284. Once we get our products, now we can make summation of our weights and products. That is a simple total: 1 plus 2, 3 plus 3, 6 plus 4, 10. 10 are our weights. For product, our total products are 3,23,154. Once we get our weights and product, now we can definitely calculate our weighted average profit. What is the formula which we have also written in the previous lecture when we were discussing about the formula related to the calculation of goodwill? That was total of products divided by total of weights. That is 3,23,154 divided by 10 is equals to 32,315.4. Once we get our weighted average profit, now we can easily calculate value of goodwill. Formula is again, as I have told earlier, quite simple. Weighted average profit multiplied by number of years purchased. Weighted average profit 32,315.4 multiplied by number of year purchased given into the question 3. Hence our valuation of goodwill is equals to 96,946. This is how we can calculate the valuation of goodwill using the weighted average profit method. This is it for this lecture. In the next video lecture, we will see the new method for calculation of value of goodwill. Until then, stay tuned. Thank you.